Thanks for joining us. Brian, welcome. Everyone watching the recording, welcome as well. I'm Steve Lentz with Discover Options. This is October 24th, 2017 with the Inside Wire. Presented material today is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Well, today we come in for a landing and settle the plane down here, finally, on our best practices broken wing butterfly. Today is the part 2 of the final back test, inclusive of contract size alterations, and so that we can get a real grip on exactly what kind of returns on your capital one can expect. All right, and so a lot of what I'm going to present today is review and summary, and then the differences between last week and this week will be near the end when we see the final back test results, and which will have the altered contract size, which, as it turns out, I was planning on just going back and changing, taking the signals from last week, going through and changing the contract size on those signals. But because of the way we calculate position delta on the additional butterflies or the leapfrog butterflies, calculating the whole positions delta, you can't just change the contract size without having to alter some strikes a little bit to make sure the deltas are balanced when you take that new position. So consequently, I had to go start from scratch completely and recast the whole back test. The signals are generally the same in terms of dates generally, but there are some differences, and certainly there's some strike differences and there's some profit and loss differences from last week as well. So hold on to your hats. We're going to do some review, and then we'll get to the back test results of this and bring it in for a landing finally. All right. So here's an overview of what we're doing here. Okay. So on the close of a technically qualified day, and we'll explain that, of course, we initiate a broken wing butterfly utilizing half of your available capital. Okay, so we scale in with half. Upon a predefined trigger getting hit, we initiate the other broken wing butterfly utilizing the other half of our available capital. So now we have 2 broken wing butterflies going on. Thereafter, when the trigger gets hit, we're going to remove the distant broken wing and implement another one more appropriately placed. This is what we call leapfrogging. Okay, so we're not making adjustments here and there to our 2 butterflies. We're completely removing one and putting a new one on. Okay, and we end this whole campaign using a profit, a loss, or a time stop. That's the overview of what we're doing. Okay, it's fairly simple. I think as these things go, it's about as simple. I think it's about as simple as you can get when you look at some of the other approaches that one can take out there and that what are being espoused. I think we're doing pretty good here for simplicity. Here's a review. We always look to the first expiry with over 60 days. When we put this thing on, we are anchoring it on an in-the-money long put. All right, and we go to the first in-the-money strike by over 5 points. Little marker down here is that we're going to favor the 25 pointers when we can in the SPX. We then go out to a strike that has a delta approximately as close to -30 as we can get. Again, we're going to fudge it a little bit if we have to get that 25 pointer, but that's generally what we're shooting for. Then we go further way out of the money, and that becomes our delta adjuster. Okay, so we go farther out of the money as far as we have to go so that when we put on the same number of strikes as the anchor, that we're going to balance the deltas. Okay, and it can be sometimes fairly close, sometimes very, very distant. Okay, now besides the position delta, the other ideal is that the entry debit should be less than 5% of the initial capital required. So if we're looking at a $10,000 net capital requirement, we want the debit for the butterfly to be under $500. Okay, and we're going to again walk into risk. We're going to scale in by halvesies. Okay. All right, so here's an example we've been using all along from November 2nd. Vol is up quite a bit. the market's beginning to go snap downward. Vol has gone up. IV percentile for a 1-year IV percentile of 80. So in this environment, here's what this looked like on November 2nd. So notice that we went to, with the market at 2097.9, we went to the 2100. That's not in the money by as much as we would prefer, but it is it hits the 25-point strike right square. So that's why we favored that. We would prefer that that were further in the money, but it's not, but that's okay because we're favoring that strike, and that is the anchor. Then we go to the strike that's approximating a negative 30, which in this case works out to be a 25-point strike. Then we go shopping for a strike down here that's going to make this thing as close to zero as possible. And in this case, we gravitate toward the 1900, which works out to have a delta of just -4 on a 5-lot butterfly here. The cash flow is under 5% of the net requirement. Okay, so that works out pretty well. When we analyze, this is a typical chart that we're going to see. Our T+0 line is quite flat, and you know, this long strike right here is slightly in the money. The here's the negative. You know, we're going to short it twice as many at the 30 delta level, and then we go long the same number of contracts as the anchor out here, and that's kind of what you look at is the. Oh, and one thing to note too is this flat expiration line here is in this case just 3% for a 3% loss. We want to make sure that that's no more than negative 5%. And sometimes you can put these on when you're actually going to be very, very, very close to the zero line. Some cases even above it. It doesn't happen that often, but that it is possible, especially when you go farther out in days like this. You can get it really high, get it up there. So now what happens? Okay, we put this thing on, and now we're going to let the market go, let the trade develop. What do we do at this point? Okay, we're going to scale in the other half when an upside trigger gets hit or a downside trigger gets hit. The upside trigger is that the underlying advances and hits the expiration break-even intersection. I take that point times 1.01, 1% above it. If that gets struck, then we go ahead and put on we scale in the other half. On the downside, when the underlying declines and hits the distant short strike, okay, real simple. We're going to time requirements to scale in. This has actually happened in the back testing. It actually went so far and so long, it actually got down, I think, to like 32, 33 days to expiration before the scale-in trigger got hit. Well, that was too close to the 30, which was our all campaign stops limit. So we're saying anything with 36 or more days, we're going to go ahead and scale in with 36 or more days. If it goes to 35 or fewer, close the position and just start up again. Okay, just get out and start up again. If it hasn't scaled in by 36 days, then forget it. Just get out and let's start all over again. So here we can see in this, here's an example from February 8th. We put this thing on, and here we're down 4%, minus 4% on the expiration break even. But we go to that expiration break even right there, and we go 1% above it, or times 1.01. That puts us to our trigger right there. And on the downside, our trigger is right where that short strike is. So now we just let the market go and develop and theta kick in. And when one of these triggers gets hit, then we take action. In this case, the market did go up, strike our trigger here. And so now what do? We go and we put on another butterfly with a short strike at around, as close to negative 30 as possible. And when we did that, this is the kind of look you're going to get typically. Okay, we have the anchor strike. Again, right here, a little bit in the money. We have the minus 30 delta here. Here's the original butterfly. Here's the new one going in. And then we have the new, the delta adjuster strike for the whole position. And we position that one appropriately so that this T plus 0 line is as flat as possible. All right. Okay, so that is scaling in the butterfly, and at this point, we now have we now have our trigger points for leapfrogging. Again, the expiration break even right here plus 1%, and then now, but mind you, if this happens to be positive, if we're doing this and it's actually a credit at this point and it's above the zero break even line and there is no intersection, go ahead and just go to that long strike and calculate 1% above it. Okay, real simple. And then the short strike of that first butterfly is our other stop. So we have our trigger to leapfrog here. So we have a 1% above, we have the distant short strike, and those are our two triggers to execute the leapfrog. Okay, and in this case, here it went up. It hit our trigger on the upside, and now what do we do? Okay, well, we're going to remove and replace. We remove this one, and we put a new one on over here, just like that. We're going to move the butterfly over. Okay, so I think you get the picture on the upside. Let's look at a downside example real quick, and then we'll get to the back test. On the downside, here we're starting on December 29th, 2015. We know the market's going to go down here, going into 2016. Boy, look at this beautiful flat T plus 0 line. Isn't that just awesome? Okay, so here we are on the 29th. The market goes down, and on January 4th, it gaps down past, at the open, it gaps through our short strike. But look at that T plus 0 line just hanging in there, down there. Isn't that beautiful? All right, so there we are. Now what do we do? Well, we're going to put on another broken wing with the short strike at a minus 30 delta over here. Okay, and so when we do that, we end up right like now. This isn't. I should have centered the 2015 over a bit, but you can kind of see here we are at 2015. Here's our short strike, and here we are at 2015. Here's our short strike, and the 30 delta was way down here. Okay, and so when we put that on, look at that. When we went shopping for that other strike, here you can kind of see that's the first butterfly strikes. The second one is the short strike here, the long strike here, and then, excuse me, that's the the long strike, and then this is the distant in the money. Okay, now is that the right one? You know what? I may have pulled an example that was wrong. This thing should be over. I think this is an example from, maybe I made a mistake here. I'm going to have to switch this out as an example. But in any case, this is correct. The leapfrog points are going to be 1% beyond the break-even expiration and the distant short strike. That part is for sure. I'm just questioning the position of these strikes here. Yeah, I think maybe that was from another example. Okay, and so here the market moves down, zzz, boom, hits the short strike. Now what do we do? Well, it's time to remove and replace. We're going to remove this one and add another one over here. Okay, and that's what it would look like when we were to leapfrog on the downside. Okay. And that's what we do. We just continually leapfrog as those trigger points get hit. Eventually, the market stops churning around, and it typically will, go into its overpriced ways, where the options typically imply more volatility than what actually occurs in the market. Doesn't always happen that way, but certainly the majority of the time, we've documented that in previous sessions here. But that's what the edge is here, is that we're dealing here with overvalued options in the SPX that typically imply more volatility than what actually comes about. How do you take advantage of that? This butterfly approach is one way to do this. Okay, we added that butterfly after removing the first, and here's our new leapfrog points. Okay, distant short strike, and 1% above that expiration break even right there. Okay, and away we go again with the theta coming in, and those are our triggers. Let's go to back testing now and go over the rules in greater detail, and then we'll show you the results. Let me get a sip of coffee here just a second. We're only going to begin this near the close of a technically qualified day. That is, anytime the underlying index is above the 50-day simple moving average, except for when the 15.33 stochastic is above its %D but below 33. That's our technically qualified days. And this is a screenshot from an inside wire from probably a year or more ago, where we documented that in the SPX, 64.7% of the bars since Jan of 2000 ended up being favorable bars, favorable meaning that the volatility implied by the options was higher than the volatility that eventually came about. That the implied move from the option prices was less, or excuse me, the implied move was more than what the move actually ended up being. Okay? 64.7% of the time, the bars were implying a greater move than what actually occurred, both to the upside and the downside. Now, okay, so what I did then is we go through and we examine then the different market environments when we're above the 50-day simple moving average and below the 50-day simple moving average. Let's go down here to the below the 50-day simple moving average first. Whenever the market was below the 50-day simple moving average, we then looked at the position of the stochastic, if it was trending up or trending down, that is above %D or below %D, and at these different overbought, oversold ranges, 0 to 33, 33 to 66, 66 to 100. You can see the percentage of bars that were favorable. Here we're in the 50s, this one in the 60s. All 6 of these are below 64.7% by these values over here on the right. So there's a negative edge in all 6 of these particular scenarios when the market is below the 50-day simple moving average. Let's go above. When the market is above the 50-day simple moving average, all right, and these different stochastic applications apply if it's trending above %D or below at these different levels, 0 to 33, 33 to 66, 66 to 100. You have then these differences, or these are the percentage of bars in that particular scenario that ended up being favorable. And you can see over here, only one of the 6 ends up having a negative edge. Okay, these two, 33 to 66, are pretty much a wash, just right there. And then, of course, when we're above 66, in both cases, whether it's trending above or below the %D, we have some good positive edges there. So we're going to go with anything above the 50-day simple moving average except for when the stochastic is trending upward but below 33. Okay, in that scenario, we will not participate. And I coded those parameters right here. Blue meaning that it's a favorable bar, meeting the 50-day with a stochastic exception. And then the red is pretty much at all times when it's underneath the 50-day simple or above the 50-day simple, but meeting that stochastic exception that we discussed. Okay, so when I did the back test, I just went through and looked at the color of the bars. Now, if you don't have Metastock and you don't want to code all this, that's fine. Just use any chart, look at the stochastic, look at the 50-day simple, and you can make that determination yourself. It's pretty easy to do. Just whenever you have to make a trade, just look at this technical condition in that regard, and away you go. Okay. Let me see here. Did I just checking one thing? Okay. All right. So, what's the next thing we did? So that's how we initiate the technical the technical day there, qualified days. Now, when do we close this whole thing? So here's some rules for closing the campaign. And when I'm going through, and I ended up doing about 23 campaigns here over the last week, we ran into a situation where You put on the butterfly, the initial one, and before you can scale in the next one, it's already made 2.5% or more. Okay, and if you put on the second one, well, now you're getting pushing close into that, towards that 35-day level, and you know you. So anyway, what I determined to do was, if that first butterfly makes 2.5%, and it's before that 35-day hit, go and and then it gets triggered, or excuse me, before it gets triggered, if your butterfly makes 2.5% on that initial bit of money, just close it out and reset. Okay, take that gain, because that's really what we're shooting for, right? Okay, we're shooting for one half of the money, one part of the money to make 2.5, the other to make 2.5, and away we. Now that's 2.5% on the total capital. Okay, the total capital, or it would be 5% on that first half. That's kind of what I mean. That's 2.5% of the total allocated capital. So what you're going to see here in this case is that we're going to allocate in the SPX $100,000. Okay, 50 will be for the first butterfly, 50 will be for the second butterfly. Okay, and if the first 50, okay, so we're gunning for 5% total on the 100, or $5,000. Okay, now sometimes we only use 90,000 of it. Okay, in that case we're gunning for 4,500. But in any case, when that first half makes 2.5% of the total, then we're going to go ahead and pull it out and reset. Okay, and just start all over again. If we get into the campaign, we scale in and off we go. When we get to have a 5% profit target hit, okay, if we've used 90,000 in capital, we make 4,500, we're pulling it off. Okay, and just taking that profit. If we lose 5% on our capital that we're using, we're going to get out at that point on a 5% loss. Okay, and then we have a few dates. Again, a scale in or a leapfrog trigger. We're going to close if we're triggered between 30 and 35 days to expiration. If we're going along, and here it's 34 days to expiration, and we get triggered, we're going to go ahead and just peel it off. Because at 30 days to expiration, no matter what we're doing, at the close of that day, when there's 30 days left, we're getting out, completely getting out, and if it's a technically qualified day, we'll reset at that point. Okay. Contract size. Oh, so let me see here. Contract size then. Okay, and here's what varies greatly from last week. In the SPX, we're going to alter the contract size so that each broken wing requires as close to 50,000 as possible. Scaled in or leapfrog broken wing butterflies may have different contract sizes from the initial one. In fact, I'm going to say in almost all cases, the scaled in or leapfrog broken wing ended up having a different contract size than that first one. And that's for various reasons. The SKUs can change. When you put in that delta adjuster, it can be farther or closer than the first one was, and so it's going to change things. And if you want that delta adjuster to be good, you're going to have to be accurate. You're going to have to do some finagling, and sometimes I had to alter a little bit where that short strike was. Okay, move it if I was really favoring a 25-pointer. But it wasn't working out, I'd have to move it around a little bit. This is where things get a little bit such that, Frank Fahey's words ring huge. What if? You have to click analyze and really play around with getting that scaled in broken wing butterfly set up so that you meet the parameters of having 5% or less debit, having a delta neutral, being using as much capital as you can, up to 50,000 for that broken wing, etc., etc. A lot of moving parts there, so you rarely hit it the first time perfect. You have to then move the contracts around and change the size a bit, and just to nail that. Let me show you an example, and this is just from the day before this one was pulled off. But you can see that one of the butterflies was a 10 lot, another of the butterflies was a 14 lot. And that made it such that it met all the parameters. We're over here on this side, it's a 1% loss over here. I think at the close of the next day, this thing was pulled off for us pretty close to a 5% gain right down here. Okay, so this worked out pretty well, but this is what your risk graph is going to look like. You're not going to have this flat line here anymore. If you're altering the contract sizes, you're going to have one of these be higher or lower than the other one by altering your contract sizes like that, okay? All right, let's take a look at the back-tested results, Brian. 5% loss of the maximum full capital allocation, or 5% loss of the current. No, it's 5% loss on the total. So if we have scaled in, if we're allocating $100,000 and we've scaled in, and we lose 5,000 on that scaled in 2 butterfly position, we're going to get out with that 5,000 loss if we've used all 100. If we've only managed to use 90,000, okay, and we're down 4,500, then we're getting out. If you have not scaled in, it's the 2.5% of the allocated of the 10,000, or excuse me, of the 100. So let's say we've put our first butterfly on, and we're down $2,500. Okay, we're aiming to spend 100,000, and we're down 2,500. We get out. Okay, hope that answers it. Back-tested results. Here we go. 23 total campaigns. This was brutal. It was brutal going because that second scaled in and then the leapfrog butterflies took some time. Just saying, and that would be there's a lot of fodder there for future presentations. I started February 24th, 2016. I started with, and I'll show you how we got into the capital that I started with. But the goal here is to reveal what the kind of yield you can get from doing this approach. We had 91% winners. Okay, 21 winners, 2 losers. Let's go take a look here. Here are the campaigns. By the way, last week's open and close dates were inaccurate. I realized the way OptionVue did it, and I was removing, the wrong rows without copying the correct open date into the correct row. But these are the accurate open and close date for each of these campaigns. I think last week one of them was just a 1 day. Open to close was 1 day, and that's not what happened. But you can see quite often here you finish up one, and the close of that day ends up being qualified, so then you start, with the next campaign right away. Sometimes you run into a situation where you close, like on October 5th, and then that entire month was unqualified. It was below the 50-day simple moving average, and we didn't enter the next one until a month later. You see that? Okay. And you can see we never, here we hit 5,000. That must have been a gap or something, but generally, if we're fully invested, as close to 100,000 as we can, we're not quite hitting that full 5% because we're in the 90s. Typically, we're in the 95,000, 90,000 range of using our capital, and that's kind of where we are. Here's one that was over 5, probably because of an overnight gap or something. All right, not too bad. Now, we did have a drawdown here of over $10,000. So if you take $100,000 of our planned capital allocation plus the maximum drawdown that occurred, in this case I'm going to round it to 10,500, okay, then you add that to the initial capital required of 100. I went to 110,500 was the starting capital. Now, you may want to assume you can have 3 losers in a row and go with that. But I'm just showing you how I did it here. We started out with 110,500, allocating 100,000 per trade, per campaign, getting as close to that, allocating all 100,000 as I could. 50,000 as close as I could get to 50,000 for each broken wing butterfly we put on. And you could see here we had the 2 losers in a row here, but other than that, all winners. And we achieved, in this time from February 24th to September 21st, just last month, the trade here that's going on since then hasn't yet completed. I didn't want to throw that in. But an annualized return, and there it is, folks, 34.4%. Now, that assumes 70 cents per contract, 70 cents per contract, no slippage in the SPX. So if you're gonna not be super patient, then throw in some slippage in that, and that 34% will come down a bit. All right, but I wanted to do this so that we could get a beat on where we would be if we're actually doing this, and you can kind of go back and see these campaigns can last, certainly a month. Looks like they're lasting sometimes. I mean, the losers got taken out pretty quick. Okay, but you're looking at the better part of 3-4 weeks for most of these on the campaign. And each campaign, you're going to have a scale in, maybe 1 leapfrog, maybe 2. Sometimes there's no leapfrogs. And here's one where you can see that after just a week, you're peeling off that 2% fairly quickly here. Look at this. I mean, here we had within a week, you're peeling off, the winners right there. Not too bad. Okay. Anything else? And that's it. I think that's it. Yep. So with that, we have come in for a landing on the best practices broken wing. I'm going to convert this over to be in our curriculum as our standard butterfly approach. Frank has his own little twist. He likes to do some minor adjustments and not let the deltas go a little bit. He monitors the daily deltas and the daily Greeks. This one's focused on the deltas really super intensely when you move broken wings around, but then monitoring it is all related to where we are in the tent, the expiration tent, and not monitoring daily deltas. So there's a little bit of a difference there, but Frank will certainly be able to bring some enhancements to it. But I think this is a good base to start from for anybody, really. All right. Awesome. Thanks so much, everyone. Brian, thanks for joining us. Everyone watching, recording, thank you. We'll be back next week with more. Take care. Bye-bye.